Hello friends, James Stevenson with a reaction video to the latest Tesla valuation video posted by Aswath Damodaran, professor of business at NYU. Very well respected, rightly so, author of several books, creator of free tools people can use to value companies. He's got a website that you can check out. But today is also an episode of Breakfast with Loki, so let's go ahead and offer Loki breakfast. I never know if he's going to take it or not. He's in his condo right now, but we'll see if we can coax him out to eat breakfast. Here you go, buddy. Oh, there's breakfast. Yes. There you go, buddy. Okay, if he budges from that spot, I will try to move the Loki cam to keep an eye on him. But it looks like he is comfy in bed right now, and maybe he will stay right there. We'll see. I'm not going to make him eat if he doesn't want to. And let me share my desktop with you, show you the Twitter profile of Professor Damodaran here. He's got a website I just mentioned right there. You can go check out. I'm not going to show you his whole video. It's 27 minutes long. That's a long video, but I will show you portions of it. Let me bring it up where I have his video queued, and I'm not going to play it right now, but what I will show you, oh, there's his website. You can go check out. A couple of things here. I think I have these lined up in order. Yeah, so the first time Professor Damodaran did his valuation on Tesla, he actually did a pretty good job forecasting the revenue. His problem was that he didn't get the margins right. And he offered a very low multiple, so he had a very low expectation for how profitable Tesla would be. And I need to move fast through this video to keep it on pace, so I can't read you all of these because he's done a few over the years where he came back in and redid his valuation efforts on Tesla. So what he decided was that Tesla's stock price belonged in the $30 to $60 range at the time, pre-splits. Sorry, bless me. So, you know, after a 5-for-1 stock split and a 3-for-1 stock split, these amounts, I mean, this $60 here, if you divide it by 15, is $4 was where he had his valuation on Tesla back then. So even though he had a pretty good guess at the revenue, where the revenue would end up, $64 billion, and he does mention that in his video that Tesla just crossed $80 billion. So he wasn't way off on the revenue. He was way off on how much a company producing that much revenue would be worth, because he didn't think Tesla would be very profitable. He thought low profit margins. And he doesn't have the same exact table in this one that you will see on all the future ones. Okay, so 4 years later, 2017, Professor Damodaran came back, gave it another shot, and I'll show you this this valuation table. I hope you can see that okay. And show you what's wrong with this. There's a lot wrong with it, but the biggest miss here is that for 2017, he was starting with like $13.5 billion worth of revenue for year one, and then growing that in years 1 through 5 by only 35%. And then in years 6 through 10, decreasing the rate at which revenue grows from 35% down to only 2% by year 10. and then doing a terminal year valuation at that point. This is one of the ways you can do a valuation. You can do 10 years worth of cash flows and then say, okay, at the end of those 10 years, this is going to be a mature company and they won't be growing anymore except for, pricing, because they'll be as big a company as they're going to get. And at that point, we'll just call it a steady state business and we'll assign a terminal value to that year, because we're going to be discounting all the cash flows back anyway, and by the time you get out to year 10, that's a long way in the future. We'll call it good at that point. They're done growing after 10 years, right? Well, at the end of 10 years, he had Tesla growing to only $90 billion worth of revenue. So that's one of the problems. And I'll cheat ahead and show you what actually happened with Tesla's revenue since 2017. So it was 11.8 billion that year. We saw year one expected revenues of 13.5. Look at how much it grew. That's way more than 35% growth from 11.7 to 21.5, right? And then it grew more and more and more and more again. And by 2022, which would have been, year 5 or year 6 in this projection that he did in 2017, Tesla just reported $81,462,000,000 worth of revenue. So the revenue grew way faster than Professor Damodaran expected that it would over the first 5 years, and my expectation is that it will continue growing at something close to this rate over the next few years, because Tesla is continuing to grow and expand. The EV market is growing by leaps and bounds every year, although it's still small. There's a lot of room for EV sales to grow, and Tesla only sells 4 models today. They're going to continue to grow that while they grow the solar business, while they grow the energy business, while they sell more software products at high margins, right? So plenty of room for revenue to grow and for profitability to grow. But I'll switch back and show you the operating margins Professor Damodaran was expecting. 1%, 2%, 4%, 5%, 6%, 8, 9, 10, capping at 12% operating margin in year 10, which from 2017 would have been, 2027 or 2028. That's a long way out into the future. Okay, so that was the 2017 version. And there is a spreadsheet here that he attached to his blog post. I won't go into right now. Okay, so the next year comes around. It's 2018. We saw at the top before I started scrolling down. So he redid the table again. What did he change? Well, he's got a higher starting value because a year has passed and Tesla reported a lot of revenue growth, right? So he adjusted the starting year growth up. He ticked up the year 1 through 5 growth rate to 36%. All right, that's a tiny increase, but then still falling by year 10 to only 3% revenue growth. And you can see that here, right? Year 8, 107, year 9, 117, year 10, 120, terminal value 124. This is small growth in the out years, right? For operating margins, he did boost this up to 12% earlier, beginning in year 5, but then maxing out there and saying this company can't get more profitable than 12% operating margins. What have we actually seen from Tesla? We've seen operating margins go from the negatives in 2018, past 6% in 2020, past 12.1% in 2021, to 16.8% in the most recently reported year. These are world-class operating margins for a luxury automaker, and I don't think Tesla is done here. Listening to Zach talk about how they're managing to operating margin, thinking about how much growth Tesla still has to do over the next 10 years, selling software, selling energy storage products, it feels like Tesla's going to be growing this operating margin by a lot more, expanding factories around the world in lower cost per vehicle operating environments, ramping up Austin and Berlin and future factories. It seems like the operating margin is going to continue improving from here. But that wasn't what Professor Damodaran had in his model. In 2018, he had revenues growing to $75 billion by year 6. So year 6 from 2018 would have been 2024. So Tesla has passed this level already, a couple of years ahead of schedule from what his expectations were in this 2018 model. So let's see what happened in 2021. This is the one that he spends a little bit of time talking about during the video. Let's scroll down, take a look at what the assumptions were. Did he fix the revenue growth and the operating margin assumption problems in this valuation? Let's check it out. So year 1, $63 billion worth of revenue. Well, that number got a lot higher, a lot quicker, so that's good. Then what's the growth rate here? Okay, he's back to 35% for years 1 through 5. I think this is too low. And falling to 1.56% by year 10. Now that's way too low. It's way too low, I'm sorry. The expectation that Professor Damodaran is making here is that Tesla is a car company and that they're going to hit a ceiling on car sales because luxury automakers only sell about this many vehicles per year. And Tesla's going to get there, and they won't be able to find more buyers after that point. Now, maybe he's right, but I think he's wrong that Tesla has more opportunities to grow revenue than just that as they continue to expand the vehicle lineup, as they continue to expand the Tesla Energy division and grow into other businesses. Announce new products. Tesla has the best engineering talent in the world, and they're really, really good at manufacturing the best products available. If they continue doing that in other markets besides just automobiles, there's a lot of room to grow revenue for Tesla. But even if you only look at the automobile business, there's more room than this to grow, I think. So what's the operating margin expectation raised to? 16% by year 5, and then flatlining at 16% through the terminal year. So that was the November 2021. You can see up in the corner, a little bit obscured. That's what this model was. And he hasn't touched it since until today. So I'll play the video at this point and then show you what that table shows. So first of all, this is just Professor Damodaran in his words telling you what he's changed since the 2021 valuation. Will he finally figure out that he needs to grow the revenues by more in years 6 through 10 and grow the operating margins past 16%?
So let me talk about what I did differently in this valuation. To be honest, not that much. I'm still giving Tesla's revenues of $400 billion in 10 years. I still think that's an ambitious number. They're at $83 billion. If they get to $400 billion, they'll have revenues far larger than any other automobile company. And as I said, adding on Tesla electric batteries and solar panels is not going to make enough of a difference to total revenues because those are smaller markets. On the operating margin front, I wrestled with what to do. And here's
So you just heard Professor Damodaran say solar and energy won't cut it because those are smaller markets. Well, today they're smaller markets. Today they're low margin markets. Those markets are going to grow by a lot. The utilities worldwide are going to want to buy a lot of Tesla megapacks over future years. More people are going to want to put solar on their homes and businesses, and they're going to want battery backup solutions for those installations. So Tesla has a lot of products they can sell and a lot of incentive to do so. In the US, the Inflation Reduction Act provides a lot of benefits to people who produce a lot of sustainable energy products, who build battery cells, who deploy solar installations, who sell electric vehicles. That's going to come at a significant benefit to Tesla. If you listen to the most recent earnings call, listen to Elon's remarks about that. It's going to be serious money coming into Tesla as they expand those businesses, and it's going to produce more profits. Tesla's operating margins are going to improve over time, and Tesla's revenue is going to grow by a lot. And Professor Damodaran just explained to us that he is not going to increase those assumptions. I'll hit play again.
That's why. During 2022, Tesla's operating margin kept climbing. Remember, it was before adjustment about 12% in 2021, and with the R&D adjustment, 14.5%. Well, during 2022, Tesla's margins zoomed. 16, 17, 18%. In fact, they got a 19% margin in the first quarter. At first sight, I said, maybe I need to give them higher margins. But the last couple of quarters have given me pause, especially what we found out about price cuts coming. If you're going to cut prices and cost pressures are building up in your plants, and these are not temporary, they're going to be here, I don't see how I can push the margin up to 18 or 20%, because I think 16% is already a premium margin, and I'm going to assume that they can maintain it. Which brings me to the cost of capital. I gave Tesla a cost of capital of 10.15%, well above the cost of capital you saw in November. And that's a big shift. In my valuation, that is the biggest shift. If you put those changes together, the value per share that I get, with a $400 billion end revenue, margins of 16%, 10.15% cost of capital, the value I get is about $130 per share. On the day that I valued the company, which was yesterday, before the earnings report came out, stock was trading at $143.51. At least by my estimates, it looks like the company is slightly overvalued, maybe about 10%. And I'll admit, I had lots of assumptions here. And as in my prior valuations of Tesla, I put in distributions for my assumptions on revenue growth and margins and cost of capital, and I got a distribution of value. And you can see that, when you look at the distribution of value, the median value is about 120. The upside here is higher than the downside, but it's not as skewed as it used to be. 10 years ago, when you looked at Tesla's valuation, the right tail was much longer. There was a much greater chance of a 10-bagger, the company doing much. Those days are done. Tesla is a much bigger player. You're not going to get that kind of upside here.
All right, so that's all I'm going to play you from the video from Professor Damodaran. As I said, it's a 27.5-minute video. I think that was the most significant portion of it was just him telling us what he's changed since his previous valuation and what numbers that kicks out. So he's saying there's not much upside from here because Tesla is about as big a company as it's going to get. After these next few years of growth. Notice he reduced the year 1 through 5 revenue growth from 35% to 24% to hold it down to being only $400 billion at maturity. So he's still holding to this belief that at the end of 10 years, companies are mature and can't grow faster than low single-digit revenues from that point forward. That's a faulty assumption. There are plenty of old companies that are growing their revenues by more than low single digits every year because they figured out ways to grow, to expand, to offer more value to more people. So what did we hear him say? We heard him share conservative revenue growth assumptions based on the auto business only, pretty much, based on luxury automakers' capital efficiency and luxury automakers' margins. That's what he's using as his lens. He's not building up based on what products Tesla will be selling from what locations at a very detailed level. He's making very high level assumptions. There's no value in here for autonomy. There's no value in here for software. There's no value for the solar, the energy business. There's no value for Tesla being a leader at real world AI, at advanced manufacturing techniques. There's no value for autonomous robots in here. That's going to happen over the next 10 years, right? It looks like Tesla has a working prototype already after working on it for only a year. Now, some of Tesla's projects take 6 or 7 years to mature, but then they have a product they can sell to the market, right? What's the value of being able to replace a human worker with a robot that can work 24 hours a day if you have a pack swap capability and don't need to recharge, or if you can just plug it in while it's working. 3 shifts a day, never takes a break, never files a union grievance against you. Probably pretty high. What's Tesla's cost per unit to build those going to be at scale? Probably pretty low. So that could be part of the years 6 through 10 growth. Just throwing out an example, not promising that that's going to be one of the things that contributes significant value to Tesla's valuation long term. But the energy storage business will absolutely grow. Tesla is going to keep producing more and more battery cells, 4680 cells every year, and they've got plenty of products to put those cells in, including utility scale storage solutions, right? They can sell very profitably as that business ramps up. And Tesla is going to be building future factories. The world needs more EVs, and Tesla will be offering more affordable EVs. Elon has dropped a lot of hints without Osborning the current lineup. What else did I want to say about that? Well, let's show you the exhibits that were too small for you to see on the screen. That's just the link to the video. Yeah, let me pop this open. Okay, so this is the most recent valuation, January of 23. We're starting at 101 billion now, a higher number than we saw for year 10 in some of the previous valuations we just looked at, with operating margins starting at 17.66% and then falling to 16% by year 5, where it remains through year 10. Now, why would the people who run Tesla's business want to see operating margins fall to 16% and remain there? Wouldn't they want to grow the operating margin? We heard Zach talk about this being the figure of merit that they're optimizing for at Tesla. From a finance perspective, they're targeting growth in operating margin by expanding businesses that have gross margins higher than the current amount, right? The more you can sell from your various revenue generating divisions at gross margins greater than 18%, the more you will be able to grow your operating margins, provided that you're not increasing SG&A, research and development, by more than you can grow the revenue in those divisions, right? So yeah, he's got 400 billion worth of revenue growth. I would say Tesla will be passing 400 billion worth of revenue growth, not in year 10, as Professor Damodaran has it here, but by year 4. So by 2026, Tesla will be passing this revenue threshold, and I expect operating margins from Tesla to exceed 16% every year. So those are the key changes that I think are needed to this model to raise its level. Let's see. So this is what Tesla's revenue growth actually looks like. I think I showed you that earlier. And this is what Tesla's operating margin growth has looked like recently, up 464 basis points year over year. for the most recent year. Professor Damodaran said he's concerned about price cuts. Those price cuts, I can see how somebody would think that those price cuts are a big concern by doing back of the napkin math or just applying reasoning by analogy to it and saying, well, the margins are going to get worse. As Tesla's business continues to scale, as the volume increases, even at lower ASPs, if they can continue to attack the cost side of the equation and make the options more valuable and increase the take rate on those, operating margin is going to continue to grow into the future. So those are my thoughts from a spreadsheet perspective. Let me get this Twitter window out of the way and show you what this 2013, I've got 3 Excel windows lined up here. Let me drag this one down to center it a little bit better. So here's the 2013 model, which I ought to say hats off, was way more accurate than a lot of the forecasting people were doing back in 2013. That was a long time ago for Tesla. So really, really pretty good, especially at the top line for revenues. But if this was 2013 revenue, then 14, 15, 16, 17, 18, 19, 20, 21, 22. He's got $65 billion for 2022. Tesla has beaten that already at $81 billion, and they are not growing at 2.75% from here on out, friends. They're growing at a rate way higher than that. Even Professor Damodaran now says that it's 24% for years 1 through 5. But then he's sticking with this methodology where you decrease the growth rate over years 6 through 10, even though a cursory examination of the actuals here will tell you that this approach did not work in Tesla's case. We have the actuals, the results are in. And the revenue growth rate wasn't 43%, falling to 29%, falling to 16%, falling to 3%. Over these years, it was way more than that. And so I think that same adjustment should have been made to this model in Professor Damodaran's most recent valuation, and it wasn't. He's sticking with this approach of lowering revenue growth to low single digits by year 10. So what do we have in this next one? Let's take a look at the valuation output. Okay, this is the most recent one. There's that 24% growth that I just mentioned over years 1 through 5. That needs to be a lot higher, falling to, again, 3% by year 10. That needs to be a lot higher. So when Professor Damodaran says, go ahead and plug in, whatever master inputs you want, that's not exactly true, because when you change these, let's call this growth rate 50%, and let's call this target operating margin 24%, and I'll just leave the sales to capital and the initial cost of capital assumptions where they are. What happens? It still drops it down to 3.5% by year 10 on you, right? So even though you told it, hey, I want 50%, it's only giving you that for 5 years, and then it's falling after that point. So even by making only those changes, this estimated value per share rises to $657. And I just plugged those numbers in very quickly. I don't know that Tesla's revenue is going to grow by 50% per year over the next 5 years. It may. It may miss and it may exceed that amount. I don't know if Tesla's operating margins are going to beat target of 24% or not. They may beat it by a lot. But even if you only made those changes and stuck with this methodology, reducing it to 3% growth by year 10, you would still have a far higher valuation per share in this model. So that is my video for today, and with that, we'll check back in with Loki's bed where you can't even see Loki. He is down for the count, curled up, facing away from us. And I'll say if you've enjoyed today's video, click the like button. If you're not subscribed to my channel already, why not go ahead and subscribe to my channel and click the notification bell to get alerted when I post fresh content. Thank you to anyone who supports me through Patreon or by joining my YouTube channel, especially my executive producers, Kathy Kitchler and Halter Ferguson Financial, and I will see you in the next one.